Well, we got the jobs report today and it was messy, but then now we're getting headlines that's making it even messier. And I brought the perfect person in to break it all down for you. I got Jim Welsh from Macro Tides. Happy Friday, Jim. Good to see you.
Happy Friday to you, and good to see you. And it's tomorrow, Saturday.
Tomorrow is Saturday, and hopefully, and I've been preaching this to our traders in our community. It's like you can't hold stuff over the weekend. You don't know what's going to happen over the weekend, so you've got to,
Yeah,
it's better to get nice rest and relaxation over the weekend than sitting there worried about what the hell is going to happen over the weekend from this administration. There's headlines that are hitting the wires about possible retaliation and tariffs against the tariffs that have been put against us. There's repercussions,
reciprocity.
thank you, of what Trump wants back from Europe, what they take from us, and this is hitting all the wires as we're trying to coast into a Friday, and it's not like looking like a coast. It looks like the stock market's
No
getting,
coasting allowed, even
yes,
if
no
you're on the
coasting
East or
allowed.
West Coast. No
JD
coasting.
Vance said this week something to this effect, and I'll just say it, and those of you that saw the actual headline or the comment would be like, "Well, you thought we did a lot of work. Now you should wait for the next 4 years. It's going to be like this every day." So hey, as traders, that's what we look for. Let me ask you
Okay.
this: today's jobs report. There's a lot to unpack there. Why don't you go ahead and let us know how you feel about today's jobs report and what has transpired.
Yeah, well, it caps off a week of data. We got the ISM manufacturing, which got over 50 for the first time in quite a while. Manufacturing is about 12% of GDP. On the other hand, the service number dropped more than expected from, I think, from over 54 to just over 52 for services, and services are about 80% of GDP. And then within the employment report, the job number is okay, some upward revisions, but wages ticked up to 4.1% from 3.9. People were thinking that was going to ease a bit. There were massive revisions to data, I think, through March of last year, which added a bunch of jobs to the household survey. So, and then last but not least, the University of Michigan number came out, and the optimism and current view of the economy dropped way more than people expected. And from the Fed's point of view, something that they will pay attention to, Blake, is that the 1 year inflation expectation went from 3.3 to 4.3%. In Powell and Company,
That was a huge jump.
yeah, yeah. I mean, I think it's probably going to ease back just because, to your point, it's a huge jump in 1 month. But Powell and Company pay attention to inflation expectations because, from their standpoint, what they don't want to see is inflation expectations start to climb in coming months, whether it's in response to tariffs or anything else, because they believe, right or wrong, that inflation expectations lead behavioral changes. Gee, if I think inflation's coming, I'm going to buy now. And in a sense, we saw that in the trade report that came out for the month of December. Big, huge deficit. And as I covered in the February macro tides, what you saw in November and December is imports went up 8.8%. So what happened is big increase in the deficit. It was being driven by companies and people buying stuff prior to the anticipation of tariffs hitting in January. So behavior is
Jim,
already changing, at least from the Fed's perspective.
right. So, I mean, that makes sense. And I've heard a lot of people cite that. So then what you're telling me or telling us at this point is that the the spending is it's set to decrease. And in this uncertain environment, it's probably going to weigh on economic data moving forward. I mean, that's two
Yeah,
plus two,
that would
right?
be the lag effect. In other words, you're pulling demand forward,
Sure.
and and unless you get an incremental increase in demand, that means there's a dip coming after this. Oh, I got the stuff I wanted to get before tariffs, and then well, now I don't need to buy as much. So that's the catch 22 in those numbers.
Okay. Well, let's start off with I know you brought a bunch of slides, and
Yeah,
the
we'll
first
go
one
quickly.
you brought I think is really important because this really affects the well, I mean it affects the markets, but a
Yeah.
lot of people thought that they might target currencies. The Trump administration. This headline suggests otherwise, right?
Yes, it does. And, we have to go back to, I think, about a week ago. Trump gave a speech or, something where he said, we're going to increase the production of energy. Oil prices, gasoline prices are going to fall. Inflation is going to decline. And then the Fed will be able to cut rates. Now, what the media focused on is Trump is criticizing the Fed. He's demanding that they lower rates. Again, the amount of misinformation is extraordinary. I mean, I get people hating Trump, but if you're a reporter, just report the facts. And so I had a headline from ABC News that kind of, said, the Fed didn't lower rates last week, defying Trump. No, really. So what Besant said is their focus is, and I wrote about this in the February Macro Tide, they'd be better served on getting the 10-year down. And they're going to have to do things that address people's concerns about supply of treasuries, potential inflation from tariffs, all that happy stuff. And what Besson said is, no, we're not going to jawbone the Fed. What we're going to do is do things to get the 10-year yield down because that has real world implications in terms of mortgage rates and obviously treasury funding costs and so forth. So, you're right. I thought this was an important comment because it shows the emphasis of Besant and by, I'm sure with Trump's blessing of what they're going to do. At the same time, Blake, he said they're not changing the composition of offerings. In other words, Treasury bills, I think, have been at around 22% or so. And prior to the pandemic, they were down around 14% of all Treasury debt issuance. People were thinking, oh, maybe he's going to increase long-term issuance and bring the bill issuance down. So he also said, no, we're not going to do that. That's one of the things that helped Treasury bonds, I think, rally this week was it was like, oh, okay, we're not going to face even more supply. He's going to stick with what they've been doing.
Yeah, but the byproduct it would be a weaker dollar, I guess. I mean, that's something that you could think about, but it's going to be a hell of a sales job from Besant, right? Because you got a
Yeah,
lot of
a lot
supply
of
coming
moving
in.
parts, and not
Yeah,
all of them are moving in the same direction.
right. Okay, so tell us why did you include this?
Well, it's
No, wait,
just,
wait, but that was before you obviously made this before we got the
yes.
headlines today. So how do you feel
Yeah.
about your deal here?
Well, I'm making fun of people who are walking around or embraced what this shirt is expressing. The idea of, oh my God, last Sunday night, remember? Oh my God, the tariffs. Oh, the S&P's down 130 band. They're going to have this 30-day window we don't have to worry about. Tariff war over. Come on now. I just think that's really unlikely. You know, this is a big deal. The fact that they gave 30 days gives everybody a chance to position and negotiate. But I don't think we're done with the negotiations. The assumption here is that, okay, they did some things to stem fentanyl flow into the US and everything is copacetic and we don't have to worry about it. The next chart, which I also made before, is the trade deficit. And we've talked about it, so we don't have to do too much here, but just visually, you can see the trade deficit is enormous. And the last time it was this big, it was back obviously because of the pandemic, and the government gave people, a lot of money, and they bought stuff with that money, and a lot of, goods that were purchased, is why we had that deficit surge into the early part of 2022. But my point is, this is a problem that Trump wants to address. A few weeks ago, he had a breakfast or something with Republicans and made the comment that I think we can raise $1 trillion with tariffs. So again, to me, when I read that is like, all right, that was not in front of a microphone. That was with Republicans. So I'm just not sure, Blake, that the assumption that the trade war has ended. is correct. That I think there's more chapters to be written about trade, the negotiations, back and forth. And this is what's driving part of that equation.
Okay, well, let's talk about your next slide because I think this is an important one that you might have uncovered.
Yeah. So, I've been looking for a pullback in gold based on the chart pattern and so forth. And over the last few days, I'm starting to see this kind of stuff. We know reports that gold is shifting from London to New York. The delivery time, I guess, went from 24 hours to 8 weeks. So something is going on in terms of there being a squeeze. And the net result is we're seeing the borrowing costs spike. And this is a few days old. They're higher today than they were 2, 3 days ago. So to me, there's something going on here that I think is underpinning pretty much the nonstop move up in gold. Is it being facilitated potentially when Trump got elected? A little bit more demand for gold. The expectation tariffs would bring inflation, instability, whatever. But I think the move that we're seeing in gold, Blake, is being driven by underlying forces that, pretty powerful forces, and why we've seen gold continue to just grind higher. Somebody is being forced to buy stuff, buy gold, for whatever the reason. And so to me, this is like, okay, I don't pretend to understand all the dynamics, but obviously this is something very significant when you go back, 3+ years and you look at borrowing costs normally around zero or below zero, and suddenly they shoot up in a few weeks.
Well, Jim, you brought another chart, but apparently you gave me the same one here, so I don't have
Ah,
your other gold
shucks.
chart. But explain,
Yeah.
just further
Okay.
on, explain
Yeah,
what
yeah.
you're
The
talking
one
about.
that I apologize for dropping the ball,
No problem.
was the amount of gold on deposit at the COMEX. So I believe, and I'm going from memory, I had the numbers on the chart, of course. It was about 18 million ounces in the first week of December. Again, as of a few days ago, it was over 32 million ounces. So we're seeing this gigantic shift out of London to New York. Um, I have no idea what's, all the reasons driving that, but I think it's contributing to what we're seeing in terms of the borrowing costs. The borrowing cost on GLD all of a sudden have shot up to over 6% from virtually nothing not that long ago. We're starting to see some of it happen with silver as well. So there's something going on in the metals market that is really driving trading.
Okay,
And
so
to the
there's
extent,
something just it's hard to put your finger on what's driving gold higher, and basically you're telling us there's some underlying things that could be really the potential
yeah,
drivers there.
well, and I apologize for not, the other chart is just as dramatic as this one in terms of the amount of ounces going from 18 to over 32 million, whatever that number is. What's that, like 70% or something?
Yeah.
So, um, in terms of trying to understand what's going on with the gold market, I think we can't ignore this stuff. And to the extent that this stuff is driving the equation, what it means is if and when that squeeze, which I don't know of a better way to describe it, when that gets satisfied, historically, you get a very sharp break. And I'll harken back to probably the ultimate example was 1980. The Hunt brothers tried to corner the silver market. And for a while they did. Silver went from, I think, like 10, $15 to 50. And then it was down, I think, 8 days in a row limit when that basically the exchange just, put it to the Hunt brothers. They said, you can only open one position. You can't buy, you can only sell.
Yeah, right, right.
I don't know if you remember that story. It's pretty amazing. So my point here is looking at gold and look at how unrelenting. This has all the hallmarks of I don't want to say frantic buying, but obviously intense motivational buying. And what I want to point out is so far it's concentrated in gold. We'll see if it then can transform over to silver. But intermarket divergences develop when you have two instruments in the same basic market, like in this case, gold and silver, or you could
Yeah.
have the 10 and 30-year treasury, or you have the S&P versus the small cap and all that. When everything's in sync, they go up together, go down together. But when you get a move like we've seen in gold, which is now, I don't know how many percent above the high from last October, and silver is 7.5% or whatever below that high, that's an intermarket divergence. It kind of says, wait a second, something, there's an imbalance here. So my only point is I did not anticipate gold to rally this much. Been feeling really pretty stupid. And I kind of think, well, wait a second, maybe this other stuff has been really why this has happened. So I feel just slightly less stupid. But I do believe that to the extent that what I've just discussed is responsible for the last 100, $150 of movement in gold, when those dynamics reverse, I think you're looking at a very sharp decline in
But
gold.
Jim, couldn't we see gold at 3,200 and then
Yeah,
silver goes to $40?
it's again, it's if we see this, what the dynamics that are driving gold or appear to have been driving gold shift to silver, and there could be people like, hey, look at what gold's done, silver hasn't done anything. Let's buy some silver, and all of a sudden you start to get that ball rolling. You're 100% right. So all I can do is look at it right now is like, whoa, it's pretty weird to have gold so much above its October high while silver is so much below its October high.
All right. Well,
So
let's take a look at your gold chart. And I mean, this is a squeeze, obviously.
yeah, yeah. And so again, this, I've kind of covered this in the last chart, but RSI is obviously way overbought. Hey, the trend is up. Look at the 5 and 13 exponential moving averages. They've stayed constructive all along. But to the extent and when this ends, I think gold is going to have a pretty sharp break. It might happen over a very short period of time, but I think that's what's coming. So my only point is, if you're in gold and you're enjoying this run, maybe you want to have a trailing stop.
So now let's talk a little bit about the dollar because you have been looking for a decline in the dollar and a wave five, and it looks like we're doing it. And it looks like the dollar is working a little bit of a tightrope here.
Yeah, it is. That
But
spike.
I gotta say this. Typically speaking, now not at the end of 2024, we saw gold and the dollar move up the same. They had a very parallel, complementary
Right.
relationship, which isn't normal. Usually, if gold goes up, dollar goes down, vice versa. So,
Yep.
how about if gold does come down as you are predicting? Wouldn't that send the dollar sharply higher?
Not necessarily to the
Okay.
extent that this short squeeze is what's driving gold. Once the short squeeze is done, it's almost like this rally has nothing to do with almost anything, and the dollar included in that anything. So, again, to me, the dollar spike, as we saw last Sunday night on the tariff news, I think getting below 107 is important. Again, if Trump pursues tariffs aggressively and we actually move toward a tariff war, I mean, I would say, wow, I would think the dollar could trade above the highs we saw. So, I just, unfortunately, we're in an environment where events can happen overnight, interday, that are going to have an impact on markets. And we don't know how aggressive he's going to be. Is he going to go full Monty? I think Europe is ready to probably resist. Canada has also have been talking tough in terms of, okay, we're going to stop sending you 4 million barrels a day of heavy oil for your Midwest refiner. I mean, again, this could get nasty, and I have no idea if it's going to do that, but the risk is there.
Right. Okay.
So
Well, let's you've been spot on with TLT. It's actually shown a bit of a reversal here. Let me go ahead and clear that drawing. My bad. Uh, but are we stopping? Because the way I look at it, Jim, is I see a inverted head and shoulder pattern.
yeah,
Should take us a
and we
little
broke
further,
out.
but that's
Yeah.
that's just kind of
So
how I've been viewing it.
yeah, no, you're 100% right, and that implies it's going higher, and Treasury yields are going to come down. All I'm noting is, all right, we got right up to where it broke down from below that 89.42. Got a little bit above it. There's a trend line connecting the last two lows. We hit that. We've backed off a little bit. Um, the last three lows have developed when TLT and Treasury yields were going up. TLT was getting compressed. Then you get a rally and then a drop down to those lows again, and you get an RSI divergence. And that to me is what I'm, I guess, waiting for before I would say it's time to buy TLT. I
Okay.
just,
All right.
again, we don't know about the tariff stuff,
Right. That's the
and
weekend unknowns, Jim. Weekend unknowns.
known unknowns.
Unknown unknowns. All right.
Yeah,
Uh, all
wish
right.
I could be
Well,
more helpful, but to me, TOT is set up. And to your point about the inverted head and shoulder, you get down below, I can't remember if that's 88-ish, that line, 88 and a quarter, the top red line or the horizontal line where we popped above that on the weak ISM number. That's what caused TLT to pop above that little range bound trading.
yeah.
So if it gets below that 88 and a quarter or so, obviously that starts to negate the head and shoulders pattern.
All right.
So,
Just so everybody's clear here, I want to catch up everybody on this. Actually, the S&P is trading at its lows now. Jim, I know you took this at a moment in time about probably about an hour ago. We were trading a little
yep.
higher. We're actually below these little spikes right now, just barely.
Okay.
So just
Well, again, what I wrote was, last week was, I think, got a rally above 6,100, got all to 6,101 this morning. The advanced decline line has continued to kind of lag, which is a warning sign. So to me, a drop, well, I think we're going to take out 59.24. That's what I wrote an hour ago.
okay.
You
Okay.
know,
Well, maybe
so
we'll do it today, Jim. So that means you think we're going to break down and we are going to take out this 59.24. And just so everybody knows, this is something that I've been paying attention to. This low here, high here, that is a 618 retracement of this entire move. So if we end up taking out that 59.24, I'd venture to argue that's probably not a good sign.
no, I think again, you can't see it because I cut off the chart, but that blue line at the bottom that connected the last two lows,
Yeah.
well, going down to hit that line again, which would be probably, I don't
What?
know, 5,800
5,700
maybe.
maybe?
58. Yeah, I'd have to look at it. It's fairly steep.
Yeah.
So, yeah, that number is important because as you can see, that spike low last Monday morning, that channel at the S&P, a downward channel, we obviously broke out above it to going up to the 6128. ABC down to kind of retest it. And if you go back into that channel, that's not a positive thing. And I think again, the reality is Fed's not doing anything with interest rates anytime soon. And if the tariff news deteriorates and people realize, oh, wait a second, we didn't have a one-day tariff war, we've got something more on our hands. Um, I think that's problematic. The other thing I'll point out, Blake, is everybody treated the tariff, oh, it's already done. And the same thing happened with that DeepSeek thing that we talked about. You saw Nvidia get hammered and so forth. Then Google comes out and says, "Yeah, we're going to spend 75 billion." Nvidia rallied, and I think it got back just about to the near the 130 level, which is kind of like the breakdown part. But look at what Google. So my point has been, as we've talked about this, is that these companies are throwing an enormous amount of money at AI, with the hardware of AI, and all that's going to get commoditized at some point in time. And the guy from Microsoft said, well, if the costs come down, then more people have access and demand will go up. So the mentality regarding Deep Six was, oh, okay, yeah, it may be a little inconvenient, but then everything's going to be a-okay. Well, that's the same mentality approached to the trade stuff. Oh, thank God we missed that bullet. It's over. And that to me is the vulnerability of the market if and when it realizes that no, the trade war may not be over. And the money that's being spent on hardware for AI is outrageous, and companies are not likely to see a return on that investment very, very quickly.
As you're speaking about short trade wars and long trade wars, just as we were talking, the EU is to offer lower tariffs on U.S. cars. So, Jim, this is a good example of, and the euro has just bounced basically about 30 or 40 pips just on that headline. This is a good
Yep.
example of, Trump's getting what he wants.
Yeah.
He's
I don't think people know, Blake, is that after World War II, in our effort to help rebuild Europe, we basically said, Europe, you can put 100% tariff on US cars so that you can, in a sense, be insulated from our production so you can rebuild your economies, and with car production being a big part of that. Well, those 100% tariffs are still in existence. They made a lot of sense 50 years ago, 60, 70 years ago, whatever. Do they make sense today? No.
Yeah. Well, I remember I'm old enough to remember back in the 80s when you owned a BMW or a Mercedes, it was a pretty damn cool thing. You're like, ooh, you got a BMW. Ooh, you got a
Status,
Mercedes.
baby.
Nowadays it's like they're just like a Honda Civic over here. So
Yeah, yeah. Well, now we shifted to the last 5 years, I would say Tesla.
yeah,
For a
right.
lot of people, it's like, wow, I'm not only driving a Tesla, but I'm saving the planet.
All right, there you go. Double whammy. Well, Jim, I thank you for taking us through all this on a daily basis and a weekly basis. I really, really appreciate it. And I know our traders do too. Guys, gals, if you enjoy what Jim does, make sure you give him a thumbs up and comment down below if you have any comments about how great a Mercedes or BMW is versus a Honda Civic. I'd love to hear your thoughts on that. Jim, what's the best way for people to get your work
Yep.
right off the press?
All right. Macrotides.com. You can go check things out or send me an email, Jim Welsh Macro at Gmail. I'll send you the most recent publication. And I did a deep dive in the March, or pardon me, the February macro tides on a lot of the stuff we've been talking about the last 2 weeks.
All right. Well, I'm sure everybody wants to read that, and
Yeah.
it's good stuff. So, Jim, thank you so
Who's
much
going
for
to win
being
the
here.
Super Bowl, baby? Come on. Come on. We'd be remiss.
Happy Super Bowl, and down the street from me is Happy Waste Management. So it's a little bit crazy. I don't even want to venture too far away from my house over the weekend because there's too many drunk people around. So
Yeah, 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 yeah. But you didn't say who's going to win. Come on.
no, that'll be the Chiefs. So yeah.
Okay. I'm going to take the opposite side. I'm going to go
Good
with
luck.
the Eagles.
Good
I
luck.
know. I mean, listen, Mahomes is unbelievable. I'm assuming that the running back for the Eagles, if he has a good day, I think that'll make a big difference. But more than anything, I hope it's a game like so many of the Chief games this year. It gets down to the last 35 seconds.
Yes. Let's hope it's
That's the
good.
best way to end a season of football.
Have a great weekend, everybody.
You
And Jim,
too.
have a great Super Bowl weekend.
You got it, buddy. Thank you, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.